Hi, this is Vijay Bambani here, and in this video, I want to talk to you about a topic that I think should interest a whole lot of dedicated investors and traders. You see, just as you can't drive your car at a constant speed when, say, hypothetically, you are used to driving at a speed of 60 kilometers per hour, do you think you can continue to maintain that speed through a foggy road, through a rainy day, or through a bright and clear summer day? The answer is no. You must adjust your speed according to the road and the climate conditions around you. Financial markets are similar in nature. You must adapt to the market's moods, sentiments, cycles, and the economic conditions. And I can't think of any other asset class that should benefit the present ongoing economic scenario and the cycles in the market than hard assets. Hard assets are those assets which you can tangibly hold in your hands, feel them, touch them, and they are non-perishable in nature mostly. So commodities are hard assets. Bullion, metals, and you'll be surprised, even energy, natural gas and crude oil are hard assets because they can be stored and they almost have a perpetual life if stored properly. Why am I advocating commodities in this period, and what you can do to safeguard your portfolio from substantial erosion or even minor erosion for that matter? Not only do you avoid erosion, but you come up trumps and you see portfolio appreciation. Now, what is happening is that the US dollar index is telling us that this year, ahead of the US presidential election, the expected US presidential election cycle isn't really working out. I've said that in a video, in a very recent video, as to why this US presidential cycle is different from the other ones, because the standard operating procedure or the step-by-step plan, which includes firming up the dollar, is not going to pan out. So if the dollar is going to become weaker, and remember the dollar is internationally the invoicing currency, which means majority of the transactions in the commodities market, in the international export and import markets, are settled in the dollar. To that extent, the dollar is the primary reserve currency of the world, but of late, it's being seen its share of its reserve currency of the world eroding slightly. So in 2017, it was roughly 72%. In 2018, it was 67%. And in 2019, the US dollar's share as a reserve currency has fallen to 62%. So as the dollar becomes weaker, commodity prices will rise because the currency with which settlements of bills are being made is weakening. Then the asset price must rise. Think of it as a seesaw in a garden. You put a heavier kid on one side, it lifts the lighter kid up. When the currency weakens, the commodity firms up. When the commodity firms up, the currency weakens. So this is one reason. The other reason is, world over, there is an endeavor, there is a concerted effort by central banks to provide stimulus to the financial markets and to the economies by printing unbacked currency. By unbacked currency, I mean currency that is not backed by a physical or a tangible asset and or corporate earnings. So the very rules of demand and supply tells you that if the supply of any particular commodity, currency, or any tangible asset increases, the value decreases. Now that currency is becoming abundantly available thanks to the printing presses being worked over time, the purchasing power of the currencies will weaken. When the purchasing power weakens, inflation is said to go up. And look at your dictionary meaning of the word inflation. What does inflation mean? Inflation means material prices going up. What are materials and raw materials? commodities, which is why commodities should be seeing a good time as of now. The other thing that comes to my mind is when currencies are being debased and interest rates are going down, people are less likely to rush towards a bank or go and put money into fixed income securities, and will be open to the idea of investing in hard assets, in spite of the fact that Berkshire Hathaway's Warren Buffett says precious metals are useless because they neither yield a dividend nor do they give interest income. But consider this: if you were to keep your money in a fixed income security where the incomes or the yields are falling, people are pushed into seeking alternate avenues to make good their loss for the sake of survival, for the sake of lifestyles, for the sake of expenses. So inflation, which means commodity prices are going to go up, debasement or devaluation of the fiat currencies, the fall of the US dollar as a reserve currency, and the other thing that I need to bring to your attention is how commodities are actually more honest to the investor as compared to equities. We already talked about how the demand-supply equation changes or impacts the prices of any asset. Now, I have a huge gripe where equity as an investment asset class is concerned. The supply is constant. The paid-up capital of an equity, the paid-up capital of a listed company does not change day to day. But demand can be stimulated by the media, by social media, by operators, by a whisper campaign, or by even justified and fundamentally sound reasoning and logic, which means it's easier to lift up or push down equity prices because one side of the equation, which is the supply, is constant. Take the case of commodities. Do you think 5 different operators or 10 different operators can come together and say, hey, come on, let's rig up the price of crude oil. We'll double and triple it from here. You think it's even possible? No, it's not possible. And besides, these markets are internationally arbitrage. So the price in Tokyo impacts the price in US, which impacts the price in Europe, which impacts the price in Asia. So in order to manipulate the price of gold, silver, lead, copper, crude, natural gas, you'll have to rig up all these markets. You think one single entity can do that? I don't think so. So to that extent, in an inflationary market, when hard asset prices are going to go up because inflation means asset prices are going to go up, you're better off with hard assets in relative terms. By relative terms, I mean you do not need to sack your equity investments and make it zero and shift all your money to hard assets. By no means am I saying that. I'm just saying that if you haven't already segregated some money into hard assets, it's about time for you to get up and smell the coffee. This is your wake-up call. Continue to hold your equity investments by all means, but also consider hard assets into your portfolio. 2020 onwards might just be a sunrise period for hard assets. I'm very hopeful about that. As a matter of fact, my money is riding on this hypothesis. With this optimistic note, I say goodbye, but not before reminding you to click like on this video if you're watching it on YouTube and subscribe to my YouTube channel. In the comment section, do let me know what you think about this video and what you would want me to record in my next. And help me reach out to fellow traders and spread the cult of a 360-degree worldview of the financial markets and knowledge-based investments and trading. Do take very good care of yourself, your health, your investments, your family. Have a very profitable day. This is Vijay Bambwani signing off for now. Till we meet again in my next. Thank you. Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.